All right. Well, to all those on the call, thank you for taking the time this afternoon to join us. I know you could be anywhere on a Wednesday afternoon, but you decided to join us for Insurance 102, and we are grateful for that. I have with me today on the call Jerry Clark and Ed Sims, both with the Insurance Solutions Group here at Mariner Wealth Advisors. Once again, I'm Scott Sturgeon with the Practice Management Group. Glad again that you all could join us. So Jerry and Ed, thank you both for taking the time to, again, sit down with us.
You're welcome. Look forward to talking about this.
Thanks for having us.
Yeah. So last week, or maybe 2 weeks ago, we did a call similar to this, kind of a general format of going over some income protection topics. And today we're going to kind of switch gears a little bit, maybe focused on a little different life cycle of a client, a little different format for different, insurance solutions and products and things of that nature to meet, the demands of whatever the client might have, specifically pertaining to asset protection. So I'll just start either one of you, if you want to start. Could you kind of delve into what does asset protection mean?
Sure, I'll go ahead and jump right in. So when we're referring to asset protection here, we're referring to helping clients protect their assets in the event of a care event, like a long-term care event, a chronic illness, anything like that. Not so much like creditor protection, asset protection like that, but more along the lines of protecting assets from a long-term care situation where expenses are needed and can be high over a long period of time. So what we're going to do is we're going to go over some high-level some discussion points, maybe run through some statistics, and then we're going to go through 4 different doors, if you might, or 4 different options that we have to offer our clients depending on their facts and circumstances. There is no cookie-cutter approach to this. Everything is custom tailored to the client situation, and our ultimate goal, giving the client peace of mind, knowing that they have at least some portion of their costs that may someday be needed, covered by a solution that consists of insurance. So again, we're going to talk about 4 different solutions, and I'll turn it over to Jerry right now to just go through some statistics before we jump into that.
Thanks, Ed. So basically, if you're married out there, you have a 90% chance of either you or your spouse needing long-term care services in your lifetime, 90%. Caregivers are 2 times more likely to need long-term care services versus all others, and they typically report that when they're giving long-term care services to a loved one, that they are, in fact, in bad health themselves. 70% of adults age 65 will need long-term care services, and 20% of those will need it for in excess of 5 years. I found it very interesting the other day having a conversation with our friends at MoneyGuard, and they had indicated in 2018 that 64% of their new claims were dementia related. So we're seeing dementia is really on the rise, and it's just crazy that the costs associated with that and the length of the care needed. And then finally, the last 2 points I'll make is 80% of the individuals who need long-term care are receiving those services from a loved one at home. And I can tell you personally, that's a really bad idea. I have my own personal story, both with my father-in-law and with my dad. In the case of my father-in-law, who's terminal with cancer, he's wasted away to nothing, and one day he just couldn't get out of his chair. My brother-in-law came over to help, and my brother-in-law is a big guy, and by the time he moved him probably 20 feet to the bathroom, his back was out, and he was needing services himself. So, I mean, it's just amazing how an untrained individual cannot give this kind of care. And of course, the final point is the cost of care. If you're looking for a private room average, it's $92,000 to have a private room in a nursing home, semi-private $82,000. And if you want to get way down on the Denny's menu and just look at adult daycare, you're looking at pushing $18,000 just to have adult daycare. And then there's a smattering of services in between as well. So I'll turn it back over to Ed, and he can talk to you about some of the solutions that we use here at Mariner Insurance Resources.
And I'll just throw one more statistic in there. I was reading, actually listening to a TED talk the other day, and dementia is very serious. And the statistic that really jumped out at me was, for people that are over age 85, 50% of them will die with dementia. So half of people over age 85 will eventually die with dementia. So that was a little shocking to me.
Just such a significantly higher cost of care associated with that.
Yep.
Essentially, they're completely unable to care for themselves.
Right.
So some kind of long-term care is essentially a necessity. So the question becomes, how are you prepared?
Yep. And the Alzheimer's Association estimates that end-of-life care, at least in 2016, was between $217,000 and $341,000. So a big chunk of money. So at any rate, we're going to go through and discuss 4 different options your client has in terms of mitigating or transferring that risk and protecting assets from the expenses of long-term care. So the first one we're going to go through is traditional long-term care insurance. This has been around for a long time. When my mom bought her long-term care policy back in 2001, she bought a 10-pay. So she paid on it for 10 years, and they increased her premium one time the very last year. They don't have policies like that anymore. The problem with traditional long-term care insurance is that when the actuaries designed the policies, they didn't realize that they were going to have the claims exposure that they have, number one, and number two, they didn't realize that people were going to keep their policies a lot longer than what they've kept them. They did lapse assumptions, and they assumed that people would just let their policies lapse. That actually hasn't happened. So we've got a lot of carriers out there. Most all the carriers, I would say probably 98% of the carriers that have issued long-term care policies over the years have increased the rates. Jerry and I, we probably review on average 5 to 10 long-term care policies a week. And the question is always, what do we do about our long-term care insurance? The rates are going up another 30% or 40% or whatever, or 10% a year for the next 5 years. And that trend seems like it's going to continue. But back to the structure of traditional long-term care insurance. Traditional long-term care insurance is essentially a policy that you buy that pays a certain amount of benefit as in the form of a reimbursement for a certain duration. The trigger on the benefits, the trigger for any kind of long-term care coverage that we'll discuss is the same because it's standardized by the IRS. It's 2 of the 6 activities. It's the requirement that you cannot do 2 of the 6 activities of daily living, or you have a cognitive impairment. Some of them say it's got to be a significant cognitive impairment, but either way, there's those 2 triggers. With a reimbursement plan, which is what traditional long-term care is, you also have to be on a certified plan of care, and you have to have that care given by a certified caregiver. So there's a few more steps you got to jump through with a reimbursement plan. But traditional long-term care, the reason people like it is because the premium is low relative to the benefit today. What they don't often realize is that they have to pay this premium for the rest of their life. So, is this up here?
Yeah.
Okay. And keep in mind this talk is based on rates that we can discuss here at the end of December of 2019. These change all the time. But here's an example of if you were to get a long-term care quote, this is an example of a 65-year-old female with 6 years of benefits at $4,500 a month. And you can see at the top there, the total premium is $6,714 a year. So that premium would be due every year. This company is actually Mutual of Omaha. It's one of the few companies that actually issue new contracts in these days. there's only about 3 or 4 carriers that even sell long-term care across the country anymore. But so this is just an example of a Mutual of Omaha quote for a 65-year-old female at $4,500 per day or per month for a benefit duration of 6 years. It also has home health care and some other things like that. But this would be the format that you could see them. The long-term care. Now, another benefit of traditional long-term care that's not afforded to any other strategy is the fact that they can be what's called partnership certified and be part of the partnership program, which in essence, if you see anything or hear anything about the partnership program, essentially what it is a way for you to have your client increase the limit of their Medicaid spend down equal to the benefits available in the long-term care policy. So what that means is they don't have to spend their assets down to like $10,000 or $1,000 depending on the state. They would only have to spend their assets down to whatever the limit on the long-term care is. So in this case, it would be $325,000 plus whatever the normal limit is at the state level.
So, Ed, sorry to interrupt you. The period of 6 years is essentially from whenever that trigger occurs, benefits run for 6 years?
Correct.
Following that time?
Yeah, assuming they use the full benefit every month.
Okay.
If they don't use the full benefit every month, the duration's longer.
Gotcha. So if they have a fall and they meet they only meet one of the 6, so the policy triggers, and they go through physical therapy and they're living in some kind of facility, but then they kind of graduate out. Is that essentially kind of like a pause button, for lack of a better phrase?
Yeah, so you have to be on, this is an elimination period of 90 days, and there's an elimination period. So essentially you're paying for your own cost for the first 90 days, but Medicare actually pays for the first 100 days of skilled nursing. So if you need skilled nursing, Medicare will pay for it.
Gotcha.
So that's a common misconception is that Medicare takes care of long-term care. Well, they do for the first 100 days, but after 100 days, you're on your own.
Gotcha.
So, great question. So again, this is kind of you can look at this and say, okay, this is the least expensive way to get the most coverage in the short term, but probably the most expensive way to provide the coverage over the long term.
Okay.
So
from a kind of logistics perspective, let's say that whatever client I just made up starts this kind of process, is it just like, they contact the insurance company? Do they contact their advisor? How do we to know when the elimination period starts? Is it like the day that they're hospitalized? Kind of what are the, sorry, but window potentially breaking here in the office. What are the kind of like logistics of that? Does that make sense?
Well, you mean the claims process?
Yeah,
okay.
Yeah.
So we'll just go through it step by step. So in order to get the policy, you have to qualify. It's medically underwritten. So you'd take an exam. They'd look at your medical records, and you'd have to qualify. And once you qualify, there's different qualification levels. But so you'd qualify, and then you accept the policy, and you pay for the policy, and then someday, if you need it, your doctor would then certify that you can't do either 2 of the 6 activities of daily living, or you have a cognitive impairment. And then once that certification has been made, and our department, we help people do that all the time. Mm-hmm. It's kind of a lengthy process from time to time, but that's how it works. So it starts with the doctor's certification. Then we go to the insurance carrier saying, okay, here's what's happening. We want to make sure we're on this certified plan of care. We want to make sure it's being provided by certified caregivers, and we pay the expenses, and then we're reimbursed whatever expenses we have.
Okay, that makes sense.
So that's essentially how it works in terms of the traditional long-term care. Jared, did I miss anything?
No, I think you're on the right track. I mean, this is I like the analogy you use about how they price these products they price it like a utility prices utilities. That's a good one to go over real quickly.
Oh yeah. So as it relates to what's guaranteed here, really nothing is guaranteed in these contracts other than the fact that the premiums will go up. And premium pricing it's not the wild, wild west, but it's pretty close. So if an insurance company wants to increase the rates on traditional long-term care insurance, all they have to do is go back to the insurance commissioner and say, hey, our costs are higher than what we thought. In order for us to be around, we need to increase our rates. The insurance commissioner would say, okay, we definitely want you to be around, so we're going to approve your rate increase. Very similar to what utility companies do to your utility bills. So it's just a matter of increasing the fees over time. So that's that. But I don't have time for it. But I've got a story on Genworth and the potential purchase of Genworth's assets by Canada. But if you want to talk to me about that in more detail, just give me a call.
Nice. I thought I had a question and then it slipped. Oh, just in general, and I mean you'll get into it, so I apologize in advance. But this sample client is 65 years old. Is there a specific age at which these types of policies make sense to purchase or to start?
Well, my advice is always, if you're gonna pick a plan with an inflation option on it, I would say the sooner the better, because if you can choose a plan that's got an inflation benefit on it, it's going to grow faster the longer you live. So by waiting, you don't really get much advantage, because you want to use time value, time to your side.
Yeah. But at like the earliest age, I mean, is 50? Is it 45?
For traditional long-term care, we don't really see much being purchased on an individual basis under age 50.
Okay. That makes sense. Cool. I don't think I have any other potential questions on this one specifically. Is there any other points you wanted to touch on it?
The last thing I do want to make is traditional long-term care insurance does have a few more tax benefits in terms of the premium than any other solutions we're going to talk about. So I didn't want to leave that out. So there's a spot on your tax return you can put, based on your age, you can have it qualify towards some of your medical expenses and those type of things.
That's good to know.
There's some other tax benefits for traditional long-term care insurance that's not afforded in any other plan.
Okay. Nice. Do you want to go on to the next one?
Sure. So the next strategy is what I refer to as the hybrid long-term care plan, and this is more of a plan. You can think about it a few different ways, but this example that I have here is essentially using a male that's age 65 that basically we're putting away $100,000. We're just shifting our $100,000 from our right pocket to our left pocket, and that $100,000 is creating benefits for long-term care for us to use in the future. So if we look at this page real quick, from the left to the right is the year, the age, the premium, the surrender value. So you can see after 5 years, if this individual changes his mind, or if there's a better mousetrap, or if the government comes out and says, you're covered, we got you covered with Medicaid or something like that, Medicare, he can always just change his mind and get his money back. No tax implication, whatever. It also has a death benefit associated with it. The death benefit is just essentially a cost recovery mechanism. So it's not a use it or lose it strategy like the traditional long-term care. And then just the long-term care benefits and how they grow over time. So this plan starts out at $3,900, $3,934 a month, and grows at 5% compound for the rest of his life. So if we zip on down to, if we go down to, age 85, he's got a pool of $851,000 that's available at a little over $10,000 a month. That's available, and this is different. It's not a reimbursement plan. This is a cash indemnity plan. And how that's different than a reimbursement plan is all you have to do is qualify with your doctor of not doing 2 of the 6 activities of daily living or have a cognitive impairment. Once either one of those has been triggered, the money comes to you or your caregiver, and it's done. I mean, there's no reimbursement, there's no certified caregivers or anything like that. You can get care in your home, you can get care wherever you want. That's the beauty of these plans. So, as you can see over time, there's the benefits grow at a very large rate. And in the far right-hand column is the internal rate of return calculation, and that is the calculation that you'd have to be able to put that money somewhere, and after taxes, be able to generate, in 21 years, over 9.78% in order to equal $851,000 of benefits. This benefit is payable over 6 years, so it's a 6-year plan. So, and that's gonna cover 95% of all long-term care situations. So another way to think of this, for your clients, you can ask them, if you were to go into a long-term care facility or need care, what money would you use first? They may say, well, I've got some money over here in the bank of something. I'll probably use that first. Well, that's when you turn around and say, okay, let's talk about repositioning that money in that bank into a plan like this. Because think about it, if they got $100,000 in a bank, it's probably earning less than 0.5% interest. So let's just exchange the interest they're earning on that money for the potential, or for the guaranteed growth of that money in terms of the long-term care. So all we're doing is changing, we're shifting that $100,000 from the bank to the insurance company. And now the long-term care benefits are growing over time in exchange for that 0.5% interest. And if they ever decided they ever need that money or whatever, and it's not for long-term care, they can always have it back. Albeit this is where it's going to give them the most peace of mind to be able to say, okay, we've checked the box, we know we've got this expense covered, and some of you may be saying, okay, well, $3,900 isn't going to do much right now, but growing at 5%, I don't expect anybody that we work with to buy a policy that's going to cover 100% of the and it's going to cover all the costs. In my mind, is probably buying too much insurance. So there's a balancing act there. As a guideline, I typically don't like to see them for more than two exposure. So that's just a thought I had there.
So that's like exposure, meaning like monthly cash flow of $10,000. They're not going to get more than
right. Yeah.
6.6 for 60.
Yeah, they think
2/3 of that.
Yeah, they think it's going to be $10,000 a month now. $600 is.
So this is really a self-insurance option with transferring the tail risk to the insurance company?
That's exactly what it is.
And so if you're sitting on dead money, pretty much, at a bank, it's just dead money. The interest rates are so low. So I can literally, in the 6th year, I could get my $100,000 back and walk. I get a lot of it back in the first 5 years, but all of it back in the 6th year and beyond. And then I get that inflation, that 5% inflation, and then the internal rate of return money for claims is incredible on the far right.
Yep.
Do you see, I know we're going to cover two others. Is this one of the ones that is kind of the more, I'd say trendier, but one of the more recent developments? And are you seeing more of these being used than a more traditional type arrangement?
So this is where I would say well over half of the long-term care solutions are being placed in this type of product. This is just one of the choices that we have. One of the reasons we use a lot of Securian right now is because they've got the highest amount of indemnity benefit out there. There's only 3 carriers that have a hybrid solution with an indemnity benefit. Those are Securian, Nationwide, and Pacific Life. There's other companies that do this, like MoneyGuard with Lincoln, One America, Mass Mutual's plan, and there's one from New York Life and a couple other ones, but they're all reimbursement plans. So when a client has a choice of getting an indemnity plan versus a reimbursement, 9 times out of 10 they're gonna want the they're gonna want the indemnity, just because of the fact that it's simpler to deal with and they can be cared for wherever they want. But yeah, great question, Scott.
When you say wherever they want, it's a good segue. That's my next question. When you say wherever they want, I think I pulled a stat that said roughly 76% of Americans 50 and over want to age in place. So we talk about living in, moving to a nursing home. I think it's kind of the predominant thing that a lot of people envision, but in reality, when push comes to shove, a lot of people just don't want to leave their home.
Right.
And so, whatever the trend might be over the next 10 to 15 years, there's, from what we can kind of tell, there's this huge shift. So, long-winded question, but do these cover any kind of care, whether it's, we discussed price points earlier on shared arrangements or a private room or having a nurse come, 12 hours during the day? Is it kind of sky's the limit, or are there limits to that?
Indemnity plans, the caregiver can do whatever they want. They can. The care manager can do, have whatever kind of care they want. It's the reimbursement plans where it gets kind of sticky in terms of, they can't choose exactly who they want to provide the care.
Mm-hmm.
Healthy people want to have, the right people and the people that they want care for them, rather than have the insurance company say, yeah, you need to have, our service over here,
Sure.
come by and change your bedpan or whatever.
Yeah.
There's a non-insurance point I need to make here as well. What we're dealing with my dad and our own family is he wants to age in place, and he had a stroke this summer, and he wants to stay on the farm, and he is fighting everybody but me and my brother on, yeah, we want you to stay at the farm. And so we've done everything we can to keep him where he wants to be. But the sisters are just up in arms. His sister, my aunt, is up in arms, and they're like, oh, you got to be in town. You can't be out there. And so you're going to have those emotional things when you deal with your client base.
Right. We could run projections all day, but a huge chunk of this is what, at the end of the day, is the client really trying to do.
Right.
I think that's the key takeaway.
Peace of mind is really what this planning provides. We can say all day long that, yeah, you've got enough money to self-insure or anything like that, but when it comes down to it, oftentimes most of the time, when we have a place to go for the financial resources to get the care, they're going to get better care than if we have to, try to decide, we don't want to spend our inheritance to, give our parents the best care or somebody the best care.
Sure.
So that's always a consideration too.
So Ed, we've got a question here on chat from Doug Carroll. Why does the death benefit drop back down to $100,000 after year 6 here? So we're at 100 and change, 106 in year 6, and then you're dropping down to 100.
Yep. Bottom line is the death benefit here is just for a cost recovery mechanism, and the reason it goes up a little ways is just because some of the tax laws that deal with life insurance and premiums and death benefits.
So the corridor testing of life insurance,
yeah,
7702, 101. So just basic testing. And then the other point, I kind of like Lisa Fentress puts, this is a better solution than One America. Nice that it gives back the death benefit. So
yeah. So a nice best of both worlds in some ways. You want to go ahead and go to the third one?
Yeah, the third one. So again, the reason we're going through all these different solutions is, again, your clients are unique in all their circumstances, and not everybody's going to have the same needs. And what we do in the insurance division is help design the plans that work best for your clients, given their unique set of facts and circumstances. So this next policy it's a life insurance policy with a long-term care or chronic illness rider on it. So this is an example, and this is a very common example, to be quite honest. So it's a $500,000 life insurance policy on a 65-year-old female. The annual premium is $10,210 a year. So we're essentially buying a pool of money of $500,000 that's coming back to the family in one way or another. It's either going to come back in the form of a death benefit, or it's going to come back in the form of a chronic illness benefit at the rate of $10,000 per month for 50 months, or just over 4 months. I'm sorry, just over 4 years. So this plan is just like the one we just talked about. I want you to take a look at the second to the last sentence in the bottom paragraph where it's bold there. No receipts are ever required. So again, you can even use the benefit payments from the benefit access to pay for your friends and family members who may be providing you with the care, or what we like to call family care. So again, it gives them the freedom to pay whoever they want, however much they want of the benefits on a monthly basis. So this is just an example of $500,000. So let's use the example. Let's say this person, for 20 years they pay into this plan, so they're paying in $200,000 into the plan. And then at age 85 they need care. Let's say they need care for 3 years. So let's just say they use $360,000 worth of benefits, and the balance, $140,000. And let's say after the 3 years, the lady passes away. Well, the balance just comes in the form of the remaining death benefit, or $140,000. And another neat thing about this is, after they go on claim, the premiums aren't due anymore. So premiums stop. So regardless of the long-term care portion of it, even the death benefit portion, and I don't have the illustration here to show you the internal rate of return, but it still makes a lot of sense. Just premium versus pool of money benefit. One other thing I might add here is that for people that don't have a big lump sum of money, let's say they don't have that $100,000 in their bank account, this option can even be funded from an IRA. All we do is we can either set up a guaranteed payment from the IRA to pay this every year, or we can just take withdrawals from the IRA to pay it. But at the end of the day, we can structure a payment and customize it based on the situation of your client. Bad thing about this plan, we don't have any inflation adjustment. We're just buying the absolute dollar amount, and in this situation, we're saying, okay, we're comfortable with 10 grand a month for 50 months. We're comfortable with it today, and we're comfortable with it in 20 years. That's the downside of this plan, but the benefit is, no matter what, if we use it or not, it's coming back for sure. We know for sure the whole $500,000 is coming back to the family.
Great. And you want to cover the fourth one?
Had a question?
Yeah, we do have a question. Valerie, with an IRA payment for life insurance with LTC rider, does the payment distribute from the IRA tax-free?
No, it's taxable.
So typically what we do is we'll set up the required minimum distribution oftentimes.
Yeah, we can do it anywhere from, so some people like to know, they want to just take a chunk of the IRA, and let's say we peel off, $210,000 to make this payment. We can peel off whatever is required to peel it off, and then have that part that's peeled off on a guaranteed basis make that premium payment every year. Okay, so all the client is out some taxes, but the payment is made for sure, guaranteed every year for the rest of their life. Great question.
Okay. Thanks for the questions. My chat is not working, but thankfully I have Jerry here by my side.
Oh, we have another one.
Oh, nice.
Is the definition of chronically ill, quote unquote, the same as Securion's policy, or is it easier, harder to trigger?
So the only difference in the qualification with this plan is that there's not a 90-day wait. This one you don't have to wait the 90 days, where the Securion plan and that traditional long-term care had a 90-day wait.
So this is an easier hurdle to jump?
Correct.
Thank you, Corey.
And all these have to be certified. You have to recertify every 12 months.
So visiting the physician and...
Yep.
Okay.
It's the same with all four of these solutions.
Out of curiosity, Ed or Jerry, do you guys ever feel like, are most clients, when they are going in to kind of get that medical check, box checked or whatever, or medically cleared, are they going to their primary care physician they've gone to forever? Does the insurance company require a physician? And do you find that most physicians are pretty on board with this kind of concept?
As long as they're a U.S. certified physician, they can't go to a doctor in Mexico and have them certified. So as long as they can go to a doctor of their choice in the United States.
Okay. Cool.
Now they'll confirm all the information. The insurance
Sure.
company will confirm it all and maybe get some medical records and blah 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 and check it all out. But yeah, they don't have to go to the insurance companies. It's not like taking your car to a Progressive or State Farm to get checked out for hail damage.
Yeah. Probably for the best. We good? Go ahead to the last one.
Go.
Okay. Okay, the last strategy here is a long-term care variable annuity example. So this would apply to those people out there or those clients out there that say, okay, I can do better with my money in the market. But they still want to have complete tax-deferred growth, number one, and complete tax-free access to the money if they need it for long-term care. Okay? I doubt many of you have seen this, but this is just a quick example of this is a historical example actually of how this would work. It's a product through Lincoln, $200,000 one-time investment, and we start to we put that money, we invest it just like we would anywhere else, but now it's under the umbrella of an annuity with long-term care benefits. So we immediately get a triple on the benefit. So if you look over there in the green column where it talks about the long-term care advantage, the long-term care benefit day one is $600,000. Okay. Now they water it down in the first 5 years by saying, okay, if you go on claim in the first year, second year, third year, your benefit duration is stretched out like it says 18 years, 15 years, 12 years, 9 years, but then it gets down to 6 years, and you see that's the way they kind of water it down in the future in the early years. But over 90% of claims with regard to long-term care happen beyond age 70. This is just with non-qualified dollars, so it can't be done with an IRA, but it can be done with other non-qualified annuities. So one of the strategies that we commonly do here is that for somebody that's got a non-qualified annuity out there that's grown over time and it hasn't had a bunch of income benefits on it, so it's just purely an investment-only variable annuity that's got a ton of gains in it, we can either put it all or some portion of that into this type of plan to leverage the long-term care benefits. So let me just go back through the growth again. So back into that green column, you see that the long-term care benefits bump up to $600,000 right after we put the $200,000 in. Well, all of the growth, we get all the growth allocated as well to the increase of the long-term care benefits. So that growth will continue and continue on until we get out to, I believe it's about 72 maybe. Yeah, right about there, 73-ish. Well, it was actually 75, but we had some down years in the market where we didn't get bump ups any longer. So again, this is a great strategy for people to either, number one, access their gains that they already have in annuities, or number two, believe that the market is going to do a lot better than any other type of long-term care strategy in the future. Or number three, be able to want to have access to their cash in their investment as well. So it can be used again for either cash, long-term care, or it's even a death benefit too. But again, your clients control the tax aspect of this type of strategy. And there are a few different carriers that do these. Lincoln, I believe, is the best in terms of being able to provide. They've got the most experience in these type of solutions.
Ed, if they don't need that $177,000 each year, can they stretch the benefit?
Absolutely. Yeah, the pool will just last longer.
Gotcha. Thanks for the question, Corey.
And this plan, I don't mean to get in the weeds here, but it's these benefits and the annual LTC benefit That's for a facility benefit. If you need it for home care, they get cut in half.
Interesting. Ed, I think this is really helpful. Any other points or thoughts?
No, I think we've covered a lot today.
Yeah.
There's every circumstance that we look at and every client situation is different. And again, I just want to keep saying that every solution we have is customized, and Jerry and I do this day in and day out. It's helping advisors help their clients find the best solution.
We've got maybe like 2 or 3 minutes left, and I had a couple questions I wanted to ask.
Sure.
So I was just kind of thinking on my own before we came in, and maybe like typical scenarios where long-term solutions or long-term care solutions are going to be really especially advantageous. And what immediately came to mind, obviously you have higher net worth individuals who are going to want to look for ways to kind of offset some risk later on in life, or transplant that risk to an insurance company. But I think what came to mind, Jerry, you'd mentioned maybe in discussions you and I had before about when you're creating a plan of care, deciding between being a caregiver and a care manager. Mm-hmm. I felt like that was really a really great point, that it's important for the client to decide earlier on. The other thing, too, that came up in my mind, and Jerry, again, I will credit with you with some of this, but who don't have kids that live in town. I can think even of my friends I grew up with. A lot of their parents live here, but none of them do. So, later on, what does that look like from a care perspective? And then even just clients that don't have any children. I think there's probably a myriad of different topics that kind of come up around that. But, if there isn't someone, Jerry, for your example's perfect, if you didn't have you and your siblings, despite maybe some of the headbutting that's going on, what would your dad be, who would be there to care? Who would be kind of coordinating that plan for him? I think policies and plans like this and having conversations like this is important to kind of get in front of that. Do you guys have any other things like that come to mind?
I just think it's, I can just tell you that when the event happens, especially if it happens very abruptly like it did in our household via stroke, you're dealing with a lot of emotional stuff, and then you're also having to be level-headed and reasonable and thinking strategically about what the next move's going to be. And I'm just telling you, you don't want to be the caregiver and the care manager at the same time, because it's nearly impossible to do.
One other question I had was, doing a 1035 exchange, number one, do you see that with these types of policies? And then number two, what kinds of conversions do you see?
Yeah, so we do 1035 exchanges into the hybrid strategy. We do 1035 exchanges into life insurance strategy, and 1035 exchanges into the variable annuity or the annuity long-term care strategy. That's pretty common. So oftentimes people will have, as Jerry states, they know why they bought it, but they don't know why they own it anymore. Life insurance, and I'll use a common example. Hey, they've got a Northwestern Mutual policy now. It's got good cash value, but the only way to access the cash value is to take a loan at 8%. And so by the way, if you want to be able to access your death benefit instead of your cash value, we can show them how to, create different access points or living benefits to their policy rather than just death benefits or surrender values.
Sure. Some flexibility there,
yeah.
It sounds like. Again, tight on time. One more question. For an advisor, maybe they're listening to this call and wondering, all right, well, how do I get the conversation started with the client to get all of this going? What's a good intro, or what are some things that they should be looking for? Do you have general thoughts on questions to ask, or kind of life events or things like that you think really jump out or are good entry points to have this kind of conversation, or what the solutions might be best for them?
I would say this. One of the biggest triggers that people have in order to start these conversations, because let's just face it, as a firm, we're very reactive. So some of the biggest reactive circumstances that we come across are when our clients have been dealing with their parent situation for a long time, and they come to the advisor saying, okay, I've been dealing with this, blah, blah, it's keeping me up at night. I want to get this taken care of, so that we do it that way. So unfortunately, we spend a lot of time reacting to those situations. I wish it was the other way around. I wish our advisors would be able to say, okay, we haven't addressed this, we're going to address this now. But it's, you know, it's one of those uncomfortable situations.
Sure, sure.
I would also, in the review process, I would just make this a point, just literally something you have to check off your list. You know, even if it feels awkward talking about it, just say, oh, by the way, the old Columbo approach. You know, if this is a very uncomfortable conversation, just say, oh, by the way, we have a department that handles this next point that I got to bring up in the fiduciary role that I sit in. And have you addressed long-term care solutions? Oh, yeah. I've got plenty of money. I'm self-insured. But have you done a deep dive into it? I mean, have you really unpackaged what that looks like, being self-insured? And, you know, is there better self-insurance types of options out there? And then just maybe move the conversation away from where they're at over to our department and let us do a deeper fact find.
Yeah, one thing you'd say is, there any reason we shouldn't, at our next meeting, discuss the long-term care issues and being able to mitigate those type of costs.
Sure.
And just let them say whatever they want.
Got to bring it up.
Yep. But we do have a fiduciary responsibility to bring it up and recommend whatever we see is fit.
Outstanding. Well, again, thank you both. We are a little over time. Want to be respectful of that and everyone on the call. Thank you all again so much for taking the time to attend this. Our prior call, we've got more coming up here in the next few weeks. I would certainly encourage you, and if, for those of you maybe in your offices who haven't attended one of these, hopefully they're productive. That's really our intent. And I want to, as an aside, thank all of you who submitted questions as well. Those are, I think, the kinds of things that we're really going for, to get some good discussion around these kinds of topics, hopefully to make everyone a little more knowledgeable and, at a minimum, just a little bit better at servicing clients. So thank you all again. Until next time, we'll see you soon.
Thank you.
Thanks, guys.